Okay, thank you, Mr. Chairman. I'll start with the motivation and the purpose of this paper. One of the innovations of Basel II was that it gave a greater role to the market to discipline risk-taking by banks. And one of the channels through which this occurred is through the pricing of wholesale funds. Now, in Uganda, as well as in many other low-income economies and frontier markets, the interbank market is virtually the only significant market for wholesale funds for the bank. And you would expect that individual commercial banks would have a good understanding of the financial position of their counterparties in the market, and therefore would be able to price risk. So the purpose of this paper is to investigate whether the interest rates paid by individual commercial banks in the interbank market in Uganda over the period from 2011 to 2017 reflect measures of the riskiness of the banks, which are called financial soundness indicators. These are measures of profitability, of non-performing loans, etc., as well as other factors which we've heard about in the previous presentations, such as the size of the banks, the ownership structure of the banks, and the demand by each individual bank for funds on the interbank market relative to its overall size in the market. Now, there has been work on this issue done in developed countries, particularly the US and to some extent Europe, but there has been very little work on this issue done in low-income countries. And that's probably because there are not much publicly available data on the interbank market, on interbank transactions. So we are utilising a data set from the Bank of Uganda on interbank trades and also on the balance sheet data from banks. I will briefly say something about the structure of the market. The commercial banks dominate the financial sector, as is common in economies of this nature. As of now, there are 24 commercial banks, and there were 19 in operation throughout the period of our study, 2011 to 2017. So it's the data from those 19 that we use. Of the 24 commercial banks, 7 are globally owned banks. They have headquarters in mostly developed countries. There are 15 regional banks, mainly from Kenya, with headquarters in Kenya and Nigeria, and there are only 2 domestic banks. We divide our banks into 3 size categories. The small size banks are the ones with each has less than 1% of the market in terms of asset share. There were 9 of these banks, and they had a combined share of 6%. Our medium-sized banks have an individual market share of between 1% and 8%. And there were 10 of these banks with a combined market share of 32%. And the large banks have an individual market share of more than 8%. And there were 5 of these banks, and they have a combined market share of 62%. I'll say something about the pricing. Uganda has, over the period of our study, inflation targeting monetary policy. So the average pricing in the market is determined by the Bank of Uganda's monetary policy. So it sets a policy rate and intervenes in the money market to align the 7-day rate to that policy rate. But individual banks pay above or below the average rate, depending upon their characteristics, which is what we're investigating. So the dependent variable in our studies is the spread of that each individual bank pays above or below this average market rate in any particular period. Some data about the structure of the market in terms of the borrowing and the lending by the 3 categories of banks. You can see that the medium-sized banks play a much larger role in the interbank market compared to their own overall asset size. In fact, they borrow more than 61% of funds in the period of our study, even though which is double their overall size in the market. The large banks have tended to lend much more than they've borrowed, and this reflects the fact that they are generally very liquid. They've lent almost half the funds in the market in this period, but borrowed less than a third. And the small banks were borrowing and lending around 10%. And if you look on the right-hand side of that table, that shows you the lending and borrowing rates of the banks relative to the policy rate, and this is for overnight rates. And you can see that as you go down the column, the rates tend to reduce. So larger banks are borrowing at lower rates than medium-sized banks, which are borrowing at lower rates than small banks. But that's not, when we come to lending, we find that the larger banks are actually lending at lower rates. And I think that reflects the fact they are more liquid. That figure is just giving you the average rates for the overnight and 7-day rates over the period of our study. As I said, the average rates are driven by monetary policy, and the volumes of trading in the 7-day and 1-day rates. And those figures are giving you the rates charged by banks of different sizes to banks of different sizes. So each individual figure shows the rates charged by the big banks, the medium-sized banks, and the small banks. And you'll note all of these 3 size categories of banks charge higher rates to the smaller banks than to other categories of banks. Okay, so I'll now hand over to Thomas, who will talk about the data and the estimation strategy.
Thank you, Martin, for that introduction. Following from his presentation, it's now quite clear as per the nature of the variables that enter this kind of analysis in trying to investigate the price that individual commercial banks pay on the interbank market. We have seen that the structure, basically in terms of ownership and in terms of size, from the charts he was showing, do have an impact. There's some disaggregation along those lines. The financial soundness indicators do matter, which are measures of risk, broadly in 2 categories: loan quality or asset quality, as well as the measures of profitability that we capture, and the banker-specific demand of a quarter at any given time. Putting all those things together, if I can just flash this, we do come up with a very simple specification. And in each of those terms are defined as shown. Our dependent variable is the weighted average spread of overnight. The reason for that is that the rates are really determined by monetary policy, but the charges from bank to bank is either above or below that, depending on the liquidity conditions in the market. And how we capture that is ideally we get the quarterly average rate for each individual bank and take off the weighted average rate for a market as shown. We do capture the memory, sometimes the reputation that a bank has, information about the past borrowing behavior is quite important, which is captured by the lagged term of the dependent variable. And then we have that vector, X, which is simply a vector of financial soundness indicators, loan quality and the measure of profitability. Profitability as a ratio of capital and then equity. And then we have a vector for bank structure, basically ownership and size. As Martin put it, in terms of ownership, banks in Uganda can be put under those three categories. They are either global, regional, or domestic. And in terms of size, given the measure he used, the asset size relative to the industry asset, we have big, medium, and small. And then we also incorporate a term which has to do with the bank demand of funds on the interbank market at any particular time, which is DIT. And that one is overnight trade asset share, also defined as the trade share by individual bank, weighted by the asset share of that particular bank. Other than that, possibly one thing I have to say here is what I've been saying is exactly that. This data is for 19 banks for reasons that Martin gave. And we cover 25 quarters, 2011 Q13, Q3 to 2017 Q4. The reason for this is the time when Uganda adopted the inflation targeting monetary policy framework. So we try to avoid those issues which would take us accounting for these changes in the regime by concentrating on that. And also partly because this is the period when Bank of Uganda has been pretty active in trying to align these interbank interest rates to its monetary policy rate. Now, given all that, we just follow the practice, given the small n and the small t. So we use the fixed random effects estimators, but then we have to make a choice whether it's fixed or random effects using the Haussmann test, which did pick for us the fixed effects. Okay, in terms of this data, we begin with some bit of description, where both the mean and the median seem not to differ so much, with the exemption of return on, I think, asset. There's a significant difference there, but elsewhere it appears that we don't have an element of significant outliers, which is good. Now, I want to draw your attention to this correlation table. In a particular column 1, where we're looking at the dependent variable, which is overnight weighted average spread, vis-a-vis all the independent variables. And the purpose of this is to be able to guide us in terms of whether the signs that we do get are really in line with our expectation. And we see that the loan equality and the weighted average spread seem to have positive correlation. And so is the case with the banker demand, which is one-day trade as a share. So is the case with the small and then others. Maybe, again, before I go further, I could maybe need to define what I mean by others here in terms of the banker structure. Now, the danger we found is that in terms of bank size, we have big, medium, and small, and in terms of ownership, we have global, regional, and domestic. Now, there's some bit of overlap in this categorization. In a majority of cases, most of the big banks, they are actually foreign-owned. And having big and foreign would almost generate same data. And when you look at majority of domestic and medium, and so is, domestic and regional, and so is medium and small. Majority of these are either domestic or regional in nature. So what we do is that we concentrate on global, for example, and then the other categories, namely regional and then domestic, are put under others, and we treat that as a residual in this particular analysis. Okay. Now, following that simple strategy, we have some preliminary results here. They are still being worked on, but these are preliminary results. Overall, we see that we have about 3 sets of results, which we give model 1, 2, and 3. The reason this arises is that the measure of soundness indicators are in 3 categories. You have NPL, you have return on asset and return on equity. And indeed, when you look at this table here, you discover that NPL and return on equity have somehow significant correlation. Is quite high, and so is the case between NPL and return on asset. And so is the case with return on equity and return on asset. So we don't enter this in the same model. And this really informs why we are categorizing it along those lines to be able to come up with this different. Indeed, in the model 1, we concentrate on NPL, and the model 2 has return on equity, and the model 3 has return on asset. So that's how it comes about. Now, what do we see? Beginning with the memory, which is one-day spread, it is significant all through and positive. And we are saying that this has to do with the reputation that a particular bank has in that industry, and that reputation matters. That once you have built a good reputation, then it will persist, and it will influence the price that you have to pay henceforth going forward. Even if there are changes or short-term changes in your financial soundness indicators. And we'll look also at bank demand, which is this particular variable here, one-day trade asset. It's also positive and significant. Yes, insignificant in all specifications. And what that implies is that a bank often pays higher rates to borrow funds as the share of her borrowing relative to her total assets increase. In other words, banks do not face infinitely elastic supply curve. And when we turn to the size, big banks, which often have an international affiliation, with that the big banks have a negative sign, and also significant all through. This is a typo here. Oh no, it's okay. Significant all through. And what that means is that that cluster of banks, that termed as big or with international affiliation, tend to borrow or tend to be charged lower interest rates. Now, when we turn to the other category, which is now small, these tend to be penalized. We see a positive coefficient, although in the third category it's not being significant, but in the 2, it's a positive coefficient and significant, though not very significant. So, but what we see that such banks tend to attract unfavorable rates on the interbank market, which is quite consistent with the charts that Martin shared with us earlier. Now, when we come to measures of profitability, return on equity and return on asset, both of these have a negative sign and they are quite significant. All this means is that more profitable banks are perceived as being less of a credit risk, and therefore can borrow at lower interest rates on the interbank market. But like I mentioned, these are just preliminary findings. We have tried to do some robust, applying a technique called structure panel there, to see if we introduced, for example, these to be shocks, what would happen to the spread. And the cells are quite consistent, but we are able to document that. And if we happen to, should be able to flow quite well. Now, given that, I turn to the conclusion and the implications for regulatory policy. From what we've seen that the different measures of bank financial soundness do have an influence. So each of them has an influence on the price that a bank pays to borrow. And if a particular bank, its financial soundness indicators are weak, it's likely to pay more simply because that's consistent with a higher probability of default and there must be some caution along those lines. We also found that the volume of demand for the interbank funds by any one commercial bank relative to its size, relative to the size its size in the banking market, raises the cost of borrowing, which suggests that each bank faces an upward sloping supply curve for funds. And we've also seen very strong memory, some degree of stickiness coming out very strongly, but that has to do with the bank's reputation for riskiness, which tend to persist even when there are short-term changes in its FIs indicators. Now, given all that, of course, not forgetting that the structure in terms of ownership and asset size is also very sound, so far in the results that we see. Now, what does all this mean for banker supervisors? We see that the interbank market do impose some limited degree of discipline on the participants, because you are either disciplined or you are penalized, which is supplementary to the role of the central bank in this particular environment. But very, very importantly is that these spreads around average market rate, which is normally the policy rate, contains information about market perceptions of counterpart risk. And as a regulator, perhaps every time you see this spread expanding beyond the margins for any one commercial bank, there is a reason to ask why and be able to interrogate what the cause of this could be. With those few remarks, I'll stop at that and invite your questions.
Thank you. Plenty of time for questions. Anyone? Yes, please.
Thank you, Thomas and Martin. I was just wondering, from the evidence you presented, it's clear that the borrowing costs for small banks is elevated. So I was wondering whether if you allowed for the amount of loan size, whether this would moderate or impact the borrowing cost of small banks. Because this evidence we find in the literature, particularly by Kim, that if small banks go with a large loan to a big bank, there's consideration for the premium. So I want to find out whether, well, if you could just test for that to be sure that indeed the borrowing cost for banks doesn't matter irrespective of the amount of loan size involved.
Thanks to Martin and Thomas. A very interesting piece. I really like the way it was introduced, also from the concept of understanding Pillar 3 of Basel II. One thing that did not come up, is possibly in the paper, which I haven't looked at, is were there some mergers or acquisitions or failures during this period, banks which were initially trading but later on collapsed on running the picture, or banks which were initially trading as two banks in the market but they later merged and then became over a takeover? Just kind of see whether, kind of mention of this or somewhere. The second is that it's always assumed that in the interbank market there is no collateral, and therefore banks are basically peer monitoring each other through other parameters rather than collateral. Maybe just a mention of that or footnote of that. I assume it's the case in the case of Bank of Uganda. There is also something of interest on looking at the implications of the movement in the interbank rate versus the movements versus the, say, the discount window. Because in the case of Kenya, the wonder was, why is it that even when the interbank market rate goes up, banks do not go to the central bank. They still continue trading and trading at high interbank rates. Is that the case in Uganda? Sorry, so many comments. Maybe they are comments, basically.
Yes.
Thanks.
1 and 2. Yeah. So you go first.
Mine is a very simple clarification question. You, in your sample start from the post-IT introduction of the IT framework. Why did you decide not to include the because I would be personally interested to see whether the interbank market behavior has changed post the introduction of the inflation targeting. But you may have a reason why you don't want to include the to combine the two periods. But I'm curious to know.
One more question. Perhaps first.
Okay, thank you. Mine is methodological, because your N is much lower than the T, because you have a quarterly data for a longer time series compared to the number of banks. I don't think the fixed effects is the right framework, because you have to worry about the time series properties of your variables.
One more question
Okay,
then.
mine is a very quick one. If you look at the descriptive statistics, you can see that both returns as negative, and I don't know whether you've included them in your estimation. If you do that, the possibility of having some biases will be imminent, and the way you measure the risk, the credit risk using the spread. That's why you also say that the profitability relationship with your measure is negative. Or obviously, if you look at the spread will normally eat into your performance. I don't know the measure of the returns. If you are using either profit before tax or profit after tax, it's part of your returns. The spread is part of your returns. So you also had a problem there, having a negative relationship with the spread. So if you intend looking at the relationship between your performance and the risk, I would suggest that look at alternate measure of credit risk. If you look at the loan portfolio being a measure of credit risk, so that you can look at the relationship between the performance and the credit risk. That will give you better information than using the performance to measure against performance.
Thank you. One more question. Lady in the back.
Thank you. We know that banks trade daily on the interbank market. And if we say that pricing of interbank loans depends on these soundness indicators, the question is, how easy is it and how quickly do banks have information of other banks on these soundness indicators?
All right. Let's
Thank you. I will allow Martin to go first.
All right.
The bank will get information from the balance.
Microphone.
Just press.
Push. Yes. Okay.
The banks don't have contemporaneous information on the FSIs because that only comes out with a lag when the balance sheet data is published. But the motivation really, our sort of paper is based on the idea that banks would have market information about their counterparties. They would have better information than what is publicly available to enable them to assess the credit risk of other banks in the market. On the issue of the spread and its link with the profitability indicators, I think that that is negligible because the amount of trading which each bank is doing in the interbank market and its share, the share which that interbank trading is contributing to their income is very small indeed. The interbank loans are typically less than 5% of total assets and much less than 5% of total income. So I don't think there is a problem there. On Victor's point about 3 points, I think he raised. First of all, on the fact that the loans are uncollateralized. That is, the majority of loans certainly are uncollateralized. In Uganda, that's partly a problem of the legal status of collateral in the event of a bank closure. There were, in the period we covered, there were 2 banks which closed, and we have not included those 2 banks in our data. We have only included banks which were in operation throughout the whole 2011-2017 period, and there were no mergers and acquisitions. Okay, I can't remember the others. Thomas.
But what happened to the banks which were closed? I mean, were not then merged with?
No, the 2 banks were simply closed down and their depositors were paid off out of the available assets.
Oh, I see.
They were very small.
Thank you. I think many of these things have to do with the variables are issues that can be considered. Because, like I said, this preliminary output, and as you know, you keep improving over there. So I agree with you that if we captured, for example, the loan size in there, it could bring out the picture much better, and I think we're going to do that. Regarding the alternative measure of credit risk, to do with the same loan portfolio, same loan size, the same aspect, these are brilliant inputs that we're going to put into consideration. Now, N is less than T. We're not worried of the time series properties. Yes, I agree with you, and that's why in our other robust check, we are trying to employ something that takes account of these time series properties and see if the output is quite consistent with so far what we have. And depending on that, we may have to adjust. Depending on what comes out, we shall follow that. Okay.
There was one other question about why did we not do the pre-RTA?
Yes.
Yeah.
The
I mean, the reason we didn't was because we weren't particularly interested in that period, but we could certainly try that and see if the results are any different.
I think I would personally be interested, especially I have been using your work on with Luis on the inflation targeting framework, how this has affected the banking sector. I think it would be useful.
Okay, yeah, we will try if we have. I think we have the data. Yeah.
All right. Any other questions? If not, then we can continue discussion over coffee break. Yeah. So we finished earlier, which gives us more time to have coffee and to network. All right. Thank you very much. You were allocated more time.